crowdfunding portals or online investment portals. We have over 60 portals around the world that are using our platform to effectuate the sales, the solicitation, sale, and support of a private or exempt security. So my experience at this is from the perspective of the nuts and bolts behind the scenes of multiple different kinds of portals, selling multiple different kinds of assets, managing multiple different kinds of exemptions.
Hi, my name is Michel-Garcia. So I'm the company. So I'm the guys that are supposed to benefit from all of these exemptions. WAFU is a small little company. My background is I'm a securities lawyer. Otherwise, I've never done the fallacy of doing a complicated cross-border equity crowdfunding offering for a small company. But WAFU, which makes salad dressings and mayos, we were on Dragon's Den. We've been on Food Network. We launched the first equity crowdfunding offering in the United States by a Canadian company, raised $250,000 about a year and a half ago on a site called Circle Up in the United States that specializes in consumer packaged goods. And with the recent Jobs Act launch, one of the provisions of the Jobs Act, Title III, won't bore you with the details, it's 506C of the Reg D, allows for the first time what used to be legal or has always been legal in Canada, as Brian explained, which is accredited investor crowdfunding in Canada. You could use the internet to publicize your offer. In other words, in Canada, prior to the Jobs Act, you could say, we're offering our securities to investors as long as they're accredited investors. And that was not deemed to be a public offering. That would have been criminal no-no offense in the United States, and you couldn't do it. So when we first launched our offering in the United States, we did not publicize it, because obviously that would have been a problem. So neither in Canada nor in the United States was this offering publicized. It was held within one of these type of networks, which have closed, prior to the Jobs Act going into force, had a closed group of accredited investors, and therefore the offer was not to the public. Recently, with the enactment of Regulation 506C, which we call publicized accredited crowdfunding, we were able to launch the first publicized offering by a Canadian company simultaneously in the US and Canada. So Optimized Capital Markets, which is a dealer that was supposed to be here, runs our Canadian offering simultaneous that we have another platform in the United States called Circle Up, the same platform, doing an offering for us in the United States. Same securities, same price, same information, multi-jurisdictional cap rates for a small little public company. But people haven't talked about, we've talked about a lot about this, all the rules, is this publicity stuff allows you, the same way that I go on Dragon's Den and they offered me money and I turned it down, is it gives you publicity. As a company, the ability to get, use whatever mechanism you can to get publicity for your products, to get consumer eyeballs on your products is a great idea. That's why even just getting online here for the cooler or whatever it is, great idea. Even if you're not successful in raising funds, there is a massive added value to the publicity that crowdfunding brings you beyond and above the actual investor base. I look at it then again, I'm a company, so I look at it in the following way. Social media allows you to convert consumers into followers. You convert followers into e-commerce purchasers, and you convert all of those into shareholders. And the conversion ratios that you're going to be working on is what's going to allow this whole ecosystem to work properly. Now, when you go from the conversion from a social media follower and an e-commerce guy into a shareholder, well, obviously you're going to have to go through this panoply of rules and proper disclosure and the whole thing. But if you look at it as an ecosystem of consumer or follower, consumer, shareholder, I think that's the way that companies should be looking at it from that perspective.
Good. I'm Scott Dubin. I work for OurCrowd. We're the world's largest equity crowdfunding platform. So all these ideas we're speaking about, we're the market leader. I'm actually in Canada celebrating our first Canadian investment. So we are a curated list of opportunities. We're a curated list of accredited investors. We're the first platform to provide a liquidity event for our investors, making our investors money, which is an important part about all of this. So I'm happy to take questions about the Canadian company or the platform.
Joseph, you've been doing this for a couple of years over here. What has been your experience? And a lot of people came to this business, and a lot of people gone So where are we at now with this crowdfunding? I know you sell your portals different places in the world. I mean, you have a white label for audience. You have a white label crowdfunding platform, correct?
So there's a couple things. One is, I'll respect Brian very much, we don't call it equity crowdfunding. And there's a reason we call it securities-based crowdfunding, because there's a whole bunch of securities being sold online that are not equity. In fact, the fastest growing market for the online solicitation sale of securities is debt. And real estate-backed debt being the largest. And for obvious reasons, there's a built-in liquidity opportunity. It's securitized against real property. It's much more attractive to investors. It's also because there was a real gap in the market for that gap equity finance between what the traditional lenders would do and what was needed in the market. So one of the most exciting things we're seeing is that while the original rules were all kind of imagined by the evangelists who created the Jobs Act and the other things as being about equity financing for startups, the reality in the marketplace is that all private exempt securities, ranging from entertainment financing of films securitized against revenue, human capital contracts, debt, working capital contracts, all of these medium, or all of these different financial tools that businesses used are gradually migrating to take advantage of the efficiencies of online platforms. So as we talk about equity crowdfunding and expand that to go, oh, it's really about the online solicitation sale of securities, that there's a huge range. It's very exciting around the world of entrepreneurs migrating online. That's number one. Number two.
Yeah, just want to go over that. We go over that, but just before that, how many requests a day you get on your portal that the people want to start a portal?
Yeah. So on our site, we get about 100 a day of folks that are looking to launch some kind of platform. About 50 of those really are companies that should be going through OurCrowd's process or posting on Circle Up. They're really a company that's looking for funding, so we'll send them. Of the other 50, about half of them are pre-existing businesses.
Yeah, that's right.
That are looking to increase the efficiencies of their capital acquisition strategies by going online. And the other 50, so 25%, are new coast startups with grandiose ideas of internet and fame and fortune.
Okay, let me just offer one idea just to help differentiate.
Right.
First. So what I'll say is, the space that we're talking about here is a very exciting, interesting space. I gave a talk that I think Google hosted on equity crowdfunding, and somebody asked if you're an entrepreneur going out there to seek capital on equity crowdfunding platform, what should you begin with? What question? I think that what Joseph said, we have to center in on is you're taking on the responsibility of investors. So I imagine the vast majority of people in the room are either crowdfunding professionals or entrepreneurs seeking capital. But if you're an investor, you need to be extremely diligent to be looking for opportunities which have been vetted and are of a certain class or a certain size or a certain quality. There's a lot of fraud in the market. There's a lot of bad players in the market, and there's a lot of very small companies that are selling very nice ideas. But I think what differentiates OurCrowd is that we are actually a hybrid VC equity crowdfunding platform. We operate as such. So we are built in, if you're talking about high-tech startups, we are built in the security of a VC. Our due diligence process, the legal infrastructure behind us, the size of investment that we're doing. I'll give you a good example. We're doing a wonderful raise right now in the company called Influitive, based here in Toronto, our first Canadian-based company. This is Mark Organ's new company. Mark sold his last company, Eloqua, to Oracle for $1 billion. So when you look around the table of the other funding partners, not just OurCrowd, you see NEA, First Round, Georgian Partners, Relay Ventures. Around the other, when you look around the table, I think as investors, one of the things you want to be careful of is that it's not you and your next door neighbor. You want to see some backstop, some real due diligence a vetting process that these companies go through. If not, it's the wild, wild west out there. So, be careful.
And it's our responsibility in media, and that we screen and we do our due diligence, not just PRing and putting it in news for anybody out there. So we check CrowdFunding. We don't put any of this news out there, so we know that people are there. And one thing about Crowd, I know John very well. I know you guys also invest in some of these projects, so you're also lead investor in some of them.
So today, and this is one of the things that also helps differentiate us. So we put our own money to it, right? We have our own money at play in every deal. There are platforms, and don't forget, so the business model here is important, right? So portal producers are looking at either being paid a fee infrastructure on back end for hosting, or they're making a percentage of all money raised for the company. We don't charge our companies. We don't think, Google says do no evil. We're a nice company from Jerusalem, so I guess ours is, be a mensch. So we don't think that's very menschy to charge a company money to raise. And so we take our own money. We've raised to date about $30 million for our GP. And we put that money to work in every single deal. So at least 5%, a maximum 5% of every deal is our capital at work, which means that as a interested investor in this asset class, you all of a sudden have the added protection of knowing not only are some of the world famous angels and VCs also at the table with us, but the guy talking to you on the other end of the phone, he's got some money in the deal also. That's a big differentiator.
We should say for our audience at home watching this, that you got to be accredited investor to anybody.
Yeah, we work only with accredited investors with a certain asset level or a certain income level. We have about 8,000 in our network today.
So OurCrowd has a specific business model. It's an online VC firm. It's you leveraging the internet as a crowdfunding for a VC firm. There's literally 1,000 other business models, and many of them are great. And many of them do fantastic due diligence and operate in different business models. It's not only whether there's a fee or there's a percentage. There's lots of other business models as well. One of my favorite, our aggregate clients right now are moving about $58 million a quarter on their platforms. So it's a large, and that's still a very small percentage of the private capital that could be moving online. I'll give a couple examples to see different business models. In Texas, it has intrastate exemptions. So in Texas, a business can raise money from unaccredited investors from the state of Texas. They're all crazy, so it's okay. Just kidding. So one of our portals there is called CrowdFunders. So for $1,000, you can own a piece of an operating oil well. And the first month after you make your investment, you'll start getting the dividends in your online account. Now, traditionally, investing in oil and gas, especially existing oil wells, has been restricted to a very small sector of the investment population. And now this is an opportunity for regular folks to participate in what's a very important portion of of an important asset class. How do they make their money? They own the oil wells. So CrowdFunders actually owns all the oil wells, and they're simply liquidating through investors a percentage of their asset. So they make money because it's the asset that they're selling. So there's no fees off of it. There's no listing fees. It's a different model. And I could go through literally 1,000 different ones from portals in Israel to South Africa to Rwanda that are operating in different ways to aggregate the capital in a way that makes sense for that business or that company. And some of them are portals in the traditional sense where there's lots of different issuers, but some of them are just a developer who's constantly raising money for buildings and renovations or new construction in their local market. And they don't have access to an international pool of VC. It's not an appropriate pool for them to go to, but it is a very good way for them to access the investors that know them in their local community.
And Joseph, I should say that a total different business model. I mean, for your platform for people that institutional banks, and we should say you're here for some business too. There are people in Toronto and Canada looking for buying your platforms, infrastructures, and so OurCrowd, your platform is totally different. So that's how we.
Company for large international VCs. We're small brand, and we're based on, obviously, food, which is not a massive margin transformative industry in the world. But we, I think, epitomize small little companies in Canada that benefit from access to capital. And I think that's the point that I wanted to make, particularly to the regulators that are here, that these are the companies that are going to produce the jobs. These are the companies that are going to create accelerated growth in Canada. And these are the companies that are starving for capital. So I'll give you a little story of how we grew up. So we start, and like every other company, I take my savings, those of my mom, my dad, some of my retirement savings, and I buy and grow a company. And pretty soon I run out of capital. So then I hit up my uncles and my friends, and I do what's called a friends and family round. We raise another $500,000 and take the company to the next level. So by this time I'm around a $1.2 million company. Problem with that is none of the banks will lend to you because you're not yet a commercial lender. The people that will lend to you are the BDC and other, Investissement Quebec, we're in Quebec, so other quasi-governmental entities. If you can access this capital, and you will, it'll be expensive capital. When we started, our average interest rate was about 17.5%. Around the 1.1, 1.2 stage, we're still paying 12.5%, and that's BDC guaranteed loans. Why? Because on top of the 7% they charge you another 4.5%, 5% to guarantee the loan, so you end up in the 12 to 13 range. Very, very expensive capital. But that's not the story, particularly for the regulators. When we go and access equity capital, after the financial statements, after the percentages to the placements, after the advertisement, we still end up in a cost of capital of about 25%. Why? Because we're still raising very small amounts. And I think this is the key story that no one has told the regulators. If you limit it to without $1.5 million, what that means, that equals cost of capital of 25%. Nobody has sat down and said, done the numbers, that's what that equals. That's too expensive capital. That's too expensive for small growth companies to be paying 25 points to get capital to grow. And I understand. I understand that they're nervous, but the reality is the numbers have to add up. And so if you ask me, now we're finally defined as a commercial client, my cost of capital to grow with the banks all of a sudden is down to about 7%. Why would I pay 25% to grow on an equity side? Of course, I could go a lot faster if I did that, yes, but it would be a lot more expensive. And so one of the things that that regulators need to focus on is not just the protection of investors, but also how do they get money to companies, the right companies, the small companies, the ones that they need to be focusing on, so they accelerate growth and accelerate investment and job creation locally. Really cool ideas like the real estate, like VCs, particularly on the internet side, are always going to have multinational investors that if you've got a good idea, you'll be able to finance it. If you've got a really cool internet idea and you can't finance it, there's something wrong with the idea. There's just so much capital out there in various formats and so much money to be made. But the small little mom and pop local ones, those are the ones that have a hard time getting access to capital. Those are the ones that benefit from publicity. Those are the ones that benefit from accessing the customers. Those are the ones that benefit from arguments like buying local, buy Canadian. All those things lend themselves to equity crowdfunding and lend themselves to structures where you can access those locally. And that's why I think it's so important. One more point, and I'm not going to pick on the regulators because I'm a president of Financement Participatif en Capital Québec, which is Equity Crowdfunding Quebec. And we're bugging the local Quebec regulators, but I'll pick on the Ontario securities guys as well. Tradability of securities. One of the things that people are always concerned about is investor protection. Well, the biggest danger to investors investing in private securities is their ability to get out. And if they don't have an ability to market their securities and get out in the secondary markets, you're going to have them stuck in forever. And what's the difference from being fraudulently, basically somebody defrauding them from their money and them not being able to get out? It's exactly the same thing. They can't access the money. And so tradability of securities, which has been addressed by Regulation 8 Plus very well, should be addressed in some format in the United States. Because if you're going to let people small investors, go in and buy into a security and then say, you can't get out unless you sell it to an accredited, you're pretty much dead. There's no liquidity. I mean, there's no way to get out. And you can't force the companies to repurchase them, which is what I was forced to do. When I did an equity crowdfunding offering, most of my investors said, I want to guarantee that within 5 years, which means I had to give them a preferred share with a put. What ends up happening? Screwed up my balance sheet for a couple of years, because all of a sudden I have this contingent obligation on these guys that have an out. So it wasn't really very useful to have equity capital come in and then be treated as debt because it was contingent and could get out. So this is one of the issues that I think regulators really need to think about.
Scott, how do you guys protect your investors? You guys have a lot of institutional investors too.
Sure. So I think the first step in protecting the investor is you have to curate on both sides, right? So traditional finance has the KYC process, right? So we go through a process to verify the accreditation status of our investors. It's a very important process. And we'll have investors say, look me up on the Forbes list. Sorry, but we need you to go through the legal process. And then it's about working with the companies, right? So there was actually a wonderful article in Israel where a company talked about why it was so difficult to work with OurCrowd. And they said, we walked up to this company, we began the process, and the due diligence was just stringent. They just tore us apart. They wanted to look at our books. We have KPMG doing work for us. We have DLA Piper doing our IP work. They weren't prepared to actually do that hard work. A couple guys, a slide deck and a dream, they had a big idea. The way that we protect our investors is through a hard curation. Now, there's a lot of talk about the creation of a secondary. I won't really comment on my opinion or my company's opinion regarding the creation of a secondary market. What I will say is what's driving the capital into this asset class has been the failure of larger capital markets to produce returns for the high net worth and ultra high net worth client. So right now, high net worth clients are coming to their wealth manager, or coming to their traditional avenue and saying, bring me the 10 to 15% annualized return that I got used to earlier on in our relationship. And they say, well, I'm sorry, I can't really bring you much new alpha. Well, realistically, the new alpha is in private security. So how do we deal with that? Well, traditionally, it's to an illiquidity premium. So I don't know what it looks like for SMBs. If you're looking at traditional mom and pop shops or SMBs who are out there, equity crowdfunding. But if you look at where capital is hungry right now, and you have to follow the capital's interest, capital wants in to potentially higher return. And so we can vet that, and we can protect those investors by doing quite stringent due diligence and providing them with the legal protections that a larger overall investor would receive. As a $10,000 investor in Waze, or name the amazing company that you wish you would put $10,000 into, the worst thing in the world would have been to have put $10,000 in, have the company take the hockey stick growth, and you get diluted down to owning 2% of your friends and families around and feeling like you're back in the company, to now you own 0.0002%, right? That dilution is what kills you at the end of the day. Only with the legal protections that a larger entity like an OurCrowd can provide are you able to get the registration rights and the follow-on rights and the legal work which protects you as an investor from throwing money at a nice idea, and at the end of the day, maybe recouping a small fraction of your money, even though the company showed overall success. That's where we have to be. I think it's part of where the focus has to go for my part of the market.
I should say that all these companies have been in business for a while, and they bring a lot of credibility to our new industry, and that's what most of the regulators and say, this is new, what's going on here. But I should say, you guys took one company to public in America.
Yeah, so
what was that?
we were very, you might know that OurCrowd is based in Jerusalem, and we were lucky enough to invest in a company. It's always good to invest in a company that makes you feel good, right? So an amazing company called the Rewalk. It's a human exoskeleton that allows paraplegics to walk. Full stop. It is a miracle. I mean, however cynical you are, whatever side of finance you work on, or even if you're a regulator and stuck with the legal work, it's a miracle. A person gets up out of a wheelchair. So we were very blessed to be involved in that company to help their growth. We were a small investor, about 8-9% of the company. The company last year went public in New York, and not only brought a lot of capital in, can help the company advance, but we were very blessed us and the hundreds of investors that came along with us, that people were able to make a nice return in their investment in a structured, controlled manner. We look forward to many more successes in the year and years to come.
Joseph, you have one story here. You have a client that they're doing cancer research, and I should say that one of the great things that excite me and I'm passionate about this crowdfunding it's that social impact and social entrepreneur. Tell us about the new customer.
I'm not going to tell about that customer quite yet. I want to go. So there's a certain portion of the investor market that is looking to maximize returns. And that's a significant and it's an important part of the market. There's also a huge pool of investors that are interested in specific things, that they have an affinity for specific things. They really know medicine, or they had someone who died of leukemia and they're investing in private companies that are bringing leukemia solutions to market. They really believe in solar energy and getting away from a petroleum-based economy. So how do they invest in that? There's a huge pool. Sometimes they're called impact investors, socially responsible investing, but there's a huge pool of investors who are willing to take not maximized IPO returns, but smaller returns for the opportunity to invest in the things that they care about. Now, why this is important is because that's in fact where the traditional private capital markets have failed the biggest. You can translate these numbers from US statistics to Canadian statistics, but in the United States, that 97% of all private capital ends up in the hands of companies owned and operated by white men. The percentage of companies that are owned and operated by women that get access to private capital is, according to the Kauffman Foundation, so small it's negligible and not worth reporting. It's about 0.4%. So the issue becomes, what is the makeup of the types of companies that get funded? Do they have to move to Silicon Valley to get funded? Do they have to hire a white male CEO from Harvard, Stanford, MIT in order to be eligible for the big bump of funding of an IPO? Or are there literally the vast majority of companies producing jobs, producing wealth, that have a much more diverse ownership base and deserve a much more diverse investor base? And that's part of the biggest promise of the crowdfunding and the deregulation and the migration to taking efficiencies of the online platforms. And it's also the huge opportunity for us. So we've got a client, and that is is doing what we call a SIP, a single issuer pay, a portal of one. They're really just creating a portal for them to organize their own capital raise for their company online. They've raised $185 million from 900 doctors. And they're about to do one more round before they go public. So they are going public, but they have 4 stage 3 trials approved by the FDA in 4 different cancers for a companion care that increases the standard of life, the standard of care significantly. And when they went to the Wall Street players and the traditional VC players in New York and elsewhere, they were poo-pooed completely. Not because of the science, not because of the ownership structure, not because of the product, not because of leadership, but because, well, clearly you must not have your act together if you haven't gotten institutional investors. Why did you get it from so many people, so many individuals? Where do they all come from? Well, those were actually all the doctors that did the peer review studies and looked at their science and were like, holy cow, we have to be in on this. That's the opportunity that all of us have experiences in markets, whether it's our neighborhood or whether it's a certain kind of technology, that we would like to have the opportunity to diversify our portfolio and maybe not maximize our return of jumping on board the next WhatsApp app, but have an opportunity to really make a difference in the world around us.
That's what it's all about. We're going to take some questions. Okay. Then we get audience. Let me start with this, and we're running out of time. Audience have any questions? Okay, go ahead, Sam.
Yes, as an entrepreneur, I'm established already in television and film, and we're starting a web-based portal, a broadcast portal. And looking around at all the crowdfunding options, it's very, very confusing. to sort of see what's available where, US, Britain, here, and where do you start? And we're sort of looking, and maybe somebody has an answer for us here. We're looking in the 3 million, raising about 3 million. We've already raised $500,000, and we'd like to go to some kind of equity crowdfunding model for the remaining 2.5 million. And when you go online, it's incredibly hard to see which one would be right for you. It's very hard to make any judgments on that. Any help?
So there, I'm not going to address that specifically. You and I can talk offline. But I want to kind of, when you're looking at the portals out there, there's a metaphor that I use to understand it. Some of them are like department stores. And in a department store, product is listed on the shelf, but the customers are those of the department store, right? So if I go to an aggregator site like a Realty Mogul is one, all of the investors are Realty Moguls investors, and then they, through a special purpose investment vehicle, invest in your company. And that works for folks that don't need to own the investors directly, the customers directly. They're looking for a specific project that they're raising. We call those, think of them as a department store. The next kind of model that you'll see out there is what we call a mall, right? And a mall is where you post your store. It's still your store, but it's in their mall, and you're paying rent to be in that mall. And it might be a listing fee, it might be a percentage of the raise, there's different ways, but the value of that mall rent is the value of the walk-by traffic. And then the third option is you own your own store, that you want the customers to come in and you're going to build and own that infrastructure. And it's really a business decision about where the role of capital is going to play in your business and what's the relationship you want with those investors. So if you're looking for a one-time raise, because that's what you're going to do, and you want to kind of own those customers, you want to find a mall where that has the walk-by traffic that overlaps your targeted investor base. If you're going to be looking at it as an opportunity to raise money in an ongoing way for multiple projects, providing investors an opportunity to invest in you and potentially have access to direct revenue streams, then you probably want to own your own store.
Okay, just comment very quickly. We're looking at trying to raise our own money directly, but there's a lot of issues with it, okay? So Oscar back there's got this platform called ConX, and we were trying to hook that up so that we can raise money directly from investors. Major problems. In Canada, if you continuously raise money, you no longer qualify for the broker-dealer exemption because you're deemed to be in the business of raising capital, and therefore you would need to register as a broker-dealer to continue to raise capital for yourself. So in Canada, having a continuous offering that you link upline is just a no-go provision. In the United States, even though you're exempt from the broker-dealer registrations because all companies and officers of companies in the process of raising money for their companies are exempt from the broker-dealer rules. You're exempt from the federal broker-dealer rules, but there's some state application, some state broker-dealer rules that you have to worry about. So effectively, for your size of raise, the proprietary model where you're raising for yourself on a continuous basis is very difficult to execute. We're looking at it, but I would love to be able to do it and convert constantly.
So I'll make one.
Just real quick. So we have a platform that does that, right? So we have an out-of-the-box platform that facilitates that includes everything you need in one fee to make.
But it's in the
happen.
States. It's not.
No, it's here too.
In Canada.
We've got it in 23 countries.
How do you get around the broker-dealer?
Because you use a broker-dealer.
Oh, you use broker-dealer.
So there's one very easy answer, right? And also, how many people here are here for the purpose of learning how to utilize platforms for raising capital for their company? Just by show of hands, how many people here are here to learn how to raise capital for their? Okay, what I would say is go to the funding source, no matter what mechanism, which in accessing that crowd brings you value. Right, so we have a network of 8,000 accredited investors. There's a common term of smart money versus dumb money. I actually disagree with that construct. I actually think that when you're working with an investor base which can assist your business, it's better to take the harder, longer route. If at the end of the day, you're bringing to the table people who are strategic assistants for your business, if all you want is money, then take the easiest route, and probably banks are going to be a lot easier for you. If you're looking for the real value add of bringing on a larger investor base, maybe people from the entertainment industry who can really bring something to your business to help it grow beyond just capital, then find that partner. But those partners are harder to find because they're going to ask you more questions than you're going to ask them. But what I would say is when you sit down to begin that capital raise process, if you're looking for an easy process, then expect the investors to be of a certain structure and class. And as investors in the room, maybe, hunt down opportunities where the kind of questions that you would ask would mirror the way in which the entrepreneur sought funding. So it all has to be tied together.
Okay, well, anyone's question, we can take one.
Gentlemen on the right, I was just trying to understand the business model exactly. Are you essentially a VC fund which uses the internet to top up to the rounds that you guys are going into by accessing all your accredited investors, or?
Sure.
Is that basically
So
it?
every year we go out there and we vet about 2,000 to 3,000 companies a year. We have a pretty amazing deal flow team. We're co-investing alongside Vinod Khosla, Eric Schmidt, Betty Landa, if those people know Israel, here in Toronto, Relay, first round, Georgian, NEA. We're investing in deals that are kind of commonly accepted, good quality deals, right? We then vet those deals, we then group negotiate a larger round. So we're doing a round right now for a company at a $7.5 million raise for a very exciting company that the last chairman of Pfizer is now on the board of, in the NMJ space, for those of you who know that space. Happy to talk about that one too. We vet that deal for the larger round. We then put our own money to work in the round, and we then open it up like you do any traditional capital raise, but we do so at a minimum $10,000 investment for our crowd of investors. That process allows us to highly curate a deal and then bring it to a group of investors who, for a multitude of reasons, whether or not that be social impact or or other kinds of impact, they're all able to access a deal that they can have some relative trust in.
So you're involved in all of the deals?
Every single deal. We've invested in 67 companies. 120 million has been invested to date. Of those 67 companies, we've seen 22 go on to higher valuation follow-on rounds, which is an extremely wonderful thing for a fund our size. And we're also pleased that last year we saw our first public exit.
Are there any complications from your pool of accredited investors to investing in Canadian firms versus American versus Israeli?
We've currently done deals everywhere from Australia to Israel, now Canada, the United States. What I would say is what we offer those investors, the real value is, I think investors walk into this world and say, I want to hold a diversified fund of these opportunities. I want to mitigate out some of that risk by holding more than just one opportunity. I think many of the investors in the room have good stories of getting burned on all in on one company. By mitigating it out across multiple companies, all of a sudden you're holding, for lack of a better term, a mutual fund. You're holding a diversified, choose your own adventure venture fund, which at least there's been some backstop vetting to.
And you're not charging for this service to your accredited investors?
We charge 2 and 20 as a traditional VC or private equity fund would do.
Okay.
We charge 2% for 4 years and then 20% upside, which is pretty normal to how VC would operate.
Well, thank you very much. We're going to take you can sit these gentlemen here. They're going to be available. We're going to have a party, but we're going to take 10 minutes break, then we have the next panel.